When you picture the IRS, you likely envision a cold, mechanical bureaucracy. It is easy to assume it operates as a rigid enforcer, where a single paperwork mistake guarantees immediate financial ruin. Alongside that fear is an assumption about the agency's technological limits, that it moves too slowly to actually track the movement of complex digital finance. Tax Brief Issue 11 provides a direct look at the agency's current priorities, documenting a series of updates that challenge both of these common assumptions. First, we see the sympathetic arbiter. The modern IRS actually has a surprising capacity for leniency, frequently stepping in to forgive catastrophic administrative mistakes made by tax professionals. At the same time, we see the strict enforcer. The IRS is rapidly closing loopholes, modernizing its regulatory net to capture complex digital assets, and accelerating the timelines for long-term real estate investments. Navigating modern tax law requires recognizing this dual nature. You have to know exactly when the agency will act as a forgiving judge and when it will act as an uncompromising auditor. Let's examine the agency's capacity for leniency by looking at the high-stakes, heavily scrutinized world of estate tax planning. A critical tool for managing estate taxes for a surviving spouse is the Qualified Terminable Interest Property, or QTIP, election. Recently, a CPA completely omitted both a QTIP and a reverse QTIP election on a Form 706. The IRS did not penalize the estate for the accountant's failure. Instead, they issued a written determination granting a 120-day extension to fix the omitted paperwork, ensuring the family's wealth remained protected. We see this leniency applied to complex corporate structuring. Take the relationship between an S-corporation and its subsidiaries. In a recent case, a subsidiary accidentally made a QSub election only the parent could make and failed to file Form 8869 on time, breaking their legal structure. The IRS stepped in under Section 1362F. They granted inadvertent, invalid election relief, applying a 120-day extension and treating the structure as legally effective from the initially intended date. For taxpayers and professionals alike, these rulings confirm a vital reality. The tax code contains built-in shock absorbers designed to prevent honest clerical errors from destroying a business or liquidating an estate. While the IRS forgives the past, it is actively tightening its grip on present and future financial assets. This shift is obvious in the recent updates to Form 433B. This is the primary collection information statement a business must fill out when it owes the government money. Section 1 of the form now sets an immediate, strict requirement. If a business receives payments through virtual currency wallets, crypto exchanges, or digital platforms, they must explicitly report those channels to the IRS. Section 4, Item 20 cast the net even wider. Businesses are now mandated to report all digital assets they hold, specifically citing non-fungible tokens, or NFTs, and smart contracts. The agency is applying this same strict oversight to future economic development, specifically targeting the timeline of qualified opportunity zones. Starting with investments made on or after January 1, 2027, the rules become much tighter. Deferred gains in qualified opportunity funds must now be included in gross income within 5 years of the investment date. Yet the IRS paired this strict new rule with a massive extension for older investments. For expiring zones, like those in Puerto Rico, which expire in 2027, investors can continue to treat the area as a compliant opportunity zone all the way through December 31, 2047. The era of digital assets flying under the radar is completely over, and the IRS is aggressively laying down the regulatory tracking lines for the next 2 decades of American investment. These updates reveal that the tax code functions as an adaptive mechanism, shifting its enforcement and relief priorities to match a changing economy. Practitioners must adapt immediately. You need to update your client intake forms today to capture crypto wallets and smart contracts for collections, while actively leveraging recent private letter rulings as a safety net for your missed administrative elections. For taxpayers, the mandate is clear. Digital financial secrecy is dead. However, if you make a good faith paperwork error, the agency is equipped to fix it rather than destroy you with draconian punishments. Navigating the modern IRS requires balancing an awareness of new regulatory traps with the knowledge of where the code's relief valves are located. Subscribe for weekly updates to keep your strategy aligned with these shifts.